Ladies and gentlemen, welcome back to the channel. AMC Stock did not have the best day today. You're now in the $5 range. And yeah, where we go from here, we need to talk about it. And that's what we're going to do here in this video. We're also going to get into the data coming out tomorrow morning because there's going to be quite a bit of data, hard data, important data for the Fed, for market participants. And this is going to be very important. So we're going to talk about that, go over everything you need to know on AMC stock as well. Look at some, ex post. Can't even call them tweets anymore. Ex post from different fund managers and, how they're kind of feeling about our market. So hit that like button and subscribe to the channel if you guys have not done so already. Thanks for watching, and let's go ahead and get started. So first things first, let's run through the data coming out tomorrow. Technically, tonight at 2 o'clock in the morning, retail sales month over month come out for the UK. It's one of those situations where the UK is not the US, but you want to see, Europe doing okay, right? Europe has not been doing okay. So you want to see a good number there, but I don't think it's going to move our markets at all. Now, 4 different sets of data or data prints themselves that will be very important. Core PCE price index month over month for the month of November. You're expecting 0.2%. Last month, we also came in at 0.2%. So if you come in at 0.2%, that's okay. That's fine. That's 2.4% on a 12-month annualized basis. That's just fine. We could definitely live with that. If you come in at 0.3%, that is 3.6% on an annualized 12-month basis. Markets are not going to like that. And I don't think that's going to happen. I actually think there's a chance you come in at 0.1%. That would be 1.2% on a 12-month annualized basis. Markets would love that. Now, durable goods orders month over month are expected at 2.2%. Here's where we are in this market. Inflation's coming down. The economy's holding up. The Fed's about to start cutting rates. And the markets are expecting 6, almost 7 times now. We'll see rate cuts in 2024. That's almost a rate cut at every Fed meeting after March. That would be a rate cut at every Fed meeting after, starting in March, besides December. There's 8 Fed meetings, technically 9 throughout the year, but in January we're not expecting anything to really happen. So 7 rate cuts, you're pretty dang close to getting a rate cut at every meeting. You start to price in 8. It's a rate cut at every meeting. So that's where we are right now. Now, think about this logically. You want to see inflation continue to fall, obviously, but you want to see the economy hold up, because if the economy does not hold up, stocks are falling. Stocks are going lower from here, especially when you're trading at all-time highs on the indexes. So that would be a big problem for AMC, for the broader markets. So durable goods orders are expected at 2.2%. Last month, you were negative 5.4%. So this is very important because last month was October, right? This data is for November. So October's data looked rough, right? The economy looks like it wasn't doing that great in October. That's the first month of Q4, right? For your GDP report, you want to see this data come in good, because that's going to put a lot of pressure on December if it does not. So I personally think we might come in higher than 2.2%, maybe around 3%, 3.5%. That would be good news. Now, personal income month over month, I don't think this really matters all too much. I think 0.4%, which is the estimate, is pretty accurate. Last month was 0.2%. Maybe we come in at 0.3%. I don't think markets have real concerns at all about a wage price spiral. So if you see good income data, maybe that just means the consumer will be able to spend more money. Maybe the markets look at that as positive. That's kind of my expectation. Probably, but besides PCE, the second biggest data point is personal spending month over month. Why? Because spending is about 70% of GDP. So if spending comes in bad, let's say negative or something, yeah, GDP estimates are going to come down and the odds of recession are going to go up. So you're expecting 0.3%. Last month was 0.2%. So I'll say it like this. 0.2% would be okay. That's 2.4% annualized. It's not great. It's not recession. 0.3% is a little bit better, but you really want to come in at like 0.5% higher or more. That would be 6% annualized, roughly 6% annualized spending. That's a more, I guess, normal economy, if you will. That's a healthy economy if spending is growing 6% a year. And, you know, inflation's growing 2%, incomes are growing 3%. That's kind of the American way, right? People just spend more than they make. That's the fact of the matter. So you want to see the personal spending number come in as high as possible, because that's going to, you know, lower the odds of a recession. Also get new home sales for November and new home sales month over month as well. You're expecting home sales will improve a little bit. About 1.2%. Now, this is also important in avoiding a recession next year, because if you unlock housing, there's a lot of equity out there. People have a lot of equity in their homes. If you unlock that so people can sell their homes and buy a new one, then people are going to have more money, right? People are going to spend more. The odds of a recession are also going to fall the better real estate starts to look. Now, rates have fallen quite a bit. The data that we got yesterday really is saying people are not buying houses just because rates are falling. I think you really need to see rates fall back to like 4 or 5% to see people even able to afford the average home in the U.S. Because it's just insane, right? This house that I just bought is around $230,000, and it was with like a 7.5% interest rate. So it was like $2,000 a month. Out of the entire year, $19,000 went towards interest, and the other, $6,000 went towards principal and escrow, all those other things. So your actual principal pay down is barely anything when rates are this high. All that money is pretty much going to interest. So yeah, that's a big problem. That's why people can't afford the average home in the US, and if they can't buy another house, they're not going to sell their house now, even if they have a lot of equity. They're not going to take out lines of credit when, rates are still almost 7% for mortgages. I think you need to get back to 4 or 5% to see the real estate market really start to pick up. And that should happen in this upcoming year. Now, the markets are pricing in for January 31st, 2024, a 12.5% chance of a rate cut. You would have to see the economic data really start to look bad for a rate cut to get priced in January. It's not going to happen. Okay, it's just not going to happen. Now, let's take a look at the end of the year pricing for Fed policy. So right now we're pricing in 1, 2, 3, 4, 5, 6 rate cuts for 2024. Let's go ahead and refresh this, make sure we're looking at the same numbers, because it's saying the probability has not changed at all, and maybe that's possible. Yeah, so right now we're pricing in 6 rate cuts. The odds really have not changed from yesterday. Besides like a 1% increase for the odds of 8 rate cuts, and a little bit of an increase for the odds of 9 rate cuts. But if the economic data starts to look down, we're going to start pricing in more rate cuts, but that will be seen as a negative. If you start to price in, let's see. So you have March, May, June, that's 3. July, that's 4. September, that's 5. November, that's 6. December, that's 7. If you start to price in more than 7 rate cuts, that would be at some meeting getting a 50 basis point cut if you start to price in 8 rate cuts. So yeah, rate cuts are fine and dandy as long as inflation is falling. But if the economy starts to be the reason why markets price in rate cuts, that's not going to be great. Now, taking a look at the day-to-day 10-year Treasury yields up about 2.5 basis points. This is actually pretty interesting considering stocks today doing pretty well across the board. Russell 2000 up about 1%, NASDAQ up about 0.66%, S&P about 0.5% in the green, and the Dow is up 0.35%. A little bit more of that risk on kind of move today, although the VIX is up 3%. So that's something that kind of makes you scratch your head and say, that might not be so great. Why is the VIX up 3% when the Russell is up almost 1%? Definitely something to be watching for. Now, we also have Nike earnings today and after hours. That one can be impactful for our markets for sure. The short bear says almost 7 rate cuts are being priced in. That is shortly after the Fed guided for 3 rate cuts in 2024. The bond market has been showing clear weakness. So the bond market is just going with the flow and continuing to price in more rate cuts. Now, Mark Newton with Fundstrat, he runs the global head of technical strategy at Fundstrat. He says, quote, Wednesday's rapid about face is a short-term negative and represents the beginning of a short-term decline. Pullbacks into Friday of this week and or next Tuesday likely should prove buyable for a move back to exceed SPX 4818. So that would be 481 on the SPY. This is due to yesterday's flash crash-like event that we had where stocks got obliterated, like out of nowhere for no reason at all. What really happened, if you were a little curious or confused, what really truly happened, in my opinion, is just you were so overbought on the RSI. The SPY was at like 83. That you've seen some profit taking, you've seen some people, go short and start to play the downside. And then what happened? Everyone else started. Everyone else had the same idea. And considering there's lower, volumes during this time, typically with the holiday season, that volume had a big impact. You also had a lot of computers that were trading. And when there's low volumes in computer trading, well, that's what you get. Is what we seen yesterday, that almost like flash crash movement. This is a little bit of good news, though. It did reset the RSI back to 68.31. So now you're under 70. Now you're a little bit more in the normal range. Still sitting just at 70 is a little bit on the high side. Technically over 70 is overbought, but you're still close to that. So you're not totally out the woods. There still could be a little bit more selling to go. So we definitely want to, watch to see how that does go. Now, the car dealership guy says that there's a lot of 0% offerings that we're seeing. A lot of companies are offering very low rates. Now, the car dealership guy also says, big scoop, we're about to witness an unprecedented 1-month drop in used car values from reputable sources as always. It says Nata Books dropping 6.5% in January, highest I've ever seen, over 1.8 million in value for our inventory. So what this looks like to me, used car prices, that car inflation is, going to start really helping our CPI report. So definitely want to be watching that. Now, U.S. consumer confidence rose in December by the most since early January of 2021 as Americans grew more upbeat about the labor market and the inflation outlook. That's a good one. Says inflation is trending down, but recent soft readings are exaggerated. We expect firmer prints ahead and 2.4% core PCE for 2024. The pattern would stand at odds with the market's implied expectation for a rate cut in March. We continue to see the first cut in June. So if that is the case, if Morgan Stanley is correct, and we see the first cut in June, that means the Fed needs to start talking a big game about that. We're not seeing that as of right now. Right now, markets are firmly pricing in the first cut in March. There's a 72.6% chance of a cut in March. So you're really going to have to see a bad inflation report, the Fed really starting to talk a big game, or the Fed goes with whatever is priced in by the markets. So definitely be on the lookout for that. If we do get any pushback, that'll probably be negative for stocks. Now, again, really the economic data coming out tomorrow is going to be the big deal, because if inflation is too high or the economy is weakening, that's going to have big implications for Fed policy and where stocks go from here. Now, with that being said, in this great shift of capital, I think it's very early innings. And I think tomorrow could give you another boost to bring more money back into our markets. If PCE comes in at 0.1%, as I think it could, or even 0.2%, that's going to be good. If the economy is stronger than what people expect, that's going to be good and also bring more money back into our market. So tomorrow could actually be a big day, and tomorrow could set you up for the Santa Claus rally throughout the rest of December, even into January, because I don't believe we get the next CPI report until about mid-January, right? And your other data as well. So this is, I believe, one of the last big data reports that we will get in 2023. So if the data is good tomorrow, that's going to set us up for possibly a rally for the next 2 weeks or so. If the data is bad, well, vice versa. It's going to set you up for maybe a downside move into the end of the year. So just be prepared in your positioning. Really, I don't have much positioning at all right now because I want confirmation. And waiting for that confirmation in the data, usually not a terrible idea. Now, let's run through this Ortex data and talk about AMC a little bit more. So 9.22% short interest off free float, $141 million worth of short positions, 1.13 days to cover, 22.81 million shares that are currently sold short. 16.03 million shares currently out on loan. Cost to borrow 1.08%, utilization 23.08%, and a short score of 51.34 out of 100. Cost to borrow max at about 9%, cost to borrow minimum 2.32%, cost to borrow average 2.35%. So, what you are seeing here is just not the greatest data. AMC is really not having the greatest day today in general, as AMC plans to issue about 3.34 million additional shares. The dilution keeps rolling in, and that is definitely seen as negative for AMC stock. I mean, how could it not, right? Pretty much common sense. Now, AMC stock is back. It was in the $5 range. Now it's at $6.02, down about 2.5%. Who knows? After hours could be volatile as well as we get Nike earnings. Stocks can move here. But really, this great shift of capital, we're taking money off the sidelines. My estimate's $20 trillion or so, and putting that back into stocks. Well, it is eventually going to have a positive impact on AMC. I personally think so. But, with this dilution that we continue to see, it's really kind of putting a damper on what I would expect to have already taken place, which is a rally in AMC. So I think when we're in the early innings of this great shift of capital, it's not going to affect AMC as much as some other names. But once more liquidity does start to come into our markets, once we get kind of midway through the great shift of capital, as I'm calling it, then you start to see a lot more money flow into, stocks across the board, like AMC, which is probably not the greatest fundamental stock to own, but it's not the worst as well. AMC is not a terrible fundamental company. Sure, it has a lot of debt. The big problem really with owning AMC is Adam Aron and the dilution. So I think eventually this capital coming back into our markets will positively affect AMC, but unfortunately, it's not happening right now. Let me know what you guys think down below in the comments section. That is going to go ahead and do it for this video. Hit that like button and subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.